Be Wealthy and Smart, episode 1508.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the U.S. debt being downgraded by Moody's. Moody's is a credit rating agency, and on Friday, Moody's lowered the U.S. credit rating by one notch, which brought it in line with its peers. Moody's cited financing challenges tied to the federal government's growing budget deficit and the ramifications of rolling over existing U.S. debts in a period of high borrowing costs. This sent bond prices higher, and the 30-year U.S. bond yield rose above 5% today, and the 10-year topped 4.5%, which sent the stock market lower. Of course, rates on mortgages, car loans, and credit cards track the 10-year yield. Ross Mayfield, investment analyst at Baird, said, "The Moody's report didn't highlight anything that every investor doesn't already know about the U.S. fiscal situation. To me, it just kind of provided a little bit of cover for the market to take a breather here, but nothing that structurally changes our bullishness on where we think we'll be in the next 6 to 12 months. UBS said, in spite of Moody's downgrade, investors should continue phasing into equities. They said, "We recently cut our attractive rating on U.S. equities to neutral following the strong recent rally. However, our current neutral rating on U.S. equities should not be mistaken for a bearish view, and we continue to recommend a full strategic allocation. The recent earnings season has demonstrated the strength in structural AI earnings trends. We expect the U.S. stocks to move higher over the next 12 months, and we maintain our sector-level attractive ratings on communication services, information technology, healthcare, and utilities." Yeah, there's nothing really surprising about the downgrade of U.S. debt. Of course, we know that debt levels are getting higher and higher, and we have roughly $9 trillion that needs to be refinanced at the end of the year. The problem with higher interest rates is most of the debt already is interest. So higher interest rates just make the problem worse. So how does this impact the stock market? Well, I don't think it's going to impact the stock market in a huge way. This information was already known, and the only thing that was surprising was the timing of the downgrade, not the downgrade itself. We're still looking for higher stocks after the last week of May, but right now there's a gap to fill below us. So I do think that we have a little bit of a pullback coming to fill that gap on the chart before we see the big takeoff at the end of May, which I'm still anticipating that stocks will turn and have a very bullish run based on cycles from the end of May through the end of the year. So we're almost there. You want to take advantage of any dip as a buying opportunity. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.